What I'd like to do today is talk to you about taking your career right now and rolling it forward 30 years. And let's assume that you've listened to John and you've listened to Ethan and you've been honest, you've been effective. In other words, you did exactly what you said you were going to do. And then the third thing you did was you were innovative and you stayed ahead of technology, you stayed ahead of product development, and you actually added something and created what I would call shareholder value, which we'll talk about today. And then someone says, well, you've done such a good job at being effective and innovative and being honest, we'd like you to join our board of directors. Then you have to ask yourself the question, what happens in a boardroom? How do people make decisions in a boardroom? And that's what I'd like to talk about today. So corporate boards are challenged every day. Why? Because they report to the shareholders, and yet they don't talk to the shareholders every day. They find out whether the shareholders like the job that they're doing by watching the multiple on the stock price, or watching whether the stock price goes up or down, or watching if there are lawsuits and legal actions being taken by shareholders. So that's one of the things that you have to be aware of, is how to watch your boss. There are some natural conflicts that you have to deal with. One is the oversight role that you have versus management. Boards have oversight, not management responsibilities, and defining these lines is not always easy. The other thing is that there's oversight versus ownership. So the owners, the shareholders, reserve some rights where you don't represent them, and in fact, they want to vote themselves on some corporate governance issues. And we'll talk about some of those issues, and sometimes it's not easy to define them. And finally, I think there are models that can be agreed upon and used by both management and the board and shareholders that will allow you to make these decisions extremely effectively. So first of all, oversight versus management. Management should recommend strategy. Management should recommend compensation for people that work for them. The board should ratify it, and they shouldn't just ratify it with a rubber stamp. They should really think through what the issues are, have an intellectual framework for thinking through those issues, and only ratify once they're comfortable that they've done that effectively. Management should then execute, and then the board should review the execution to make sure it's exactly what they think the shareholders are looking for. So then you have oversight versus ownership. You have board and the management now on one side and shareholders on the other side. And major changes in corporate structure, changes in capital structure, large acquisitions or divestitures, board nominations, audit firm selections, stock-based compensation, those things will all be voted on now by the shareholders. In other words, they want a direct effect on the outcomes of those decisions. And so the board and management are now recommending to the shareholders those issues. Shareholders then can ratify via proxy statements or by special shareholder votes. Management and the board then both can have roles in the execution. Remember I said that the board should not be really so involved in the execution. There are a few places where they are. For example, with outside auditors. The board should talk to auditors directly and not have the management in between where there's a conflict of interest. And then finally, review. Shareholders review execution by management and the board via direct contact, stock purchases or sales, and class action suits. So if you're a chairman of the board, you have to be extremely tuned in to what it is that the shareholders are looking at. Short-term results versus long-term success. This will be one of the conflicts. Management focuses on quarterly results, analyst expectations, and good management also focuses on long-term issues. And that oftentimes has to do with technology development, for example, and technology strategy, especially in this business. I think there's a solution for how you deal with the long versus short. One is short-term action plans that support a clearly articulated long-term strategy, and then incentive programs that support the accomplishment of those short-term action plans. One of the things I would do is a 12 to 24 month action plan that the board signs off on every year with the board, and also a longer term 5-year plan. And the incentives will be linked to some of the short-term goals and long-term goals. So one incentive model would be to have salaries at approximately the 50th percentile of your particular area. So let's say that you're in futures, you'd be somewhere around the 50th percentile. But because you think you'll be better than everybody in the business, and I hope you all are, although that's getting difficult if you all are, but if you think that you're going to be better, you should be willing to make most of your money on an annual bonus, which will be based upon beating certain targets that have been set. So this is a floating kind of number, depending on how well you do. That number is not equity, and you shouldn't be taking away from the equity of the shareholders, so it'll probably be capped at a certain level, but give you enough upside to make it worth your while to really go out of your way to outperform. The third piece would be equity, and that's oftentimes restricted stock units, stock options with long-term vesting provisions, for example, 4 to 5 years, sometimes even longer now. And this gives an opportunity to give people incentive for a longer term period to do the right things for the corporation and not make silly mistakes because they're so focused on the short term. Because obviously 5 years from now, where you could really create wealth is by doing the right long-term things so that the company doubles or triples in value. So I think one of the most interesting things that I saw from Merton Miller, who was on my board at CME, was the concept of any investment project and its concomitant financing plan must pass only the following test. Will the project as financed raise the market value of the firm's shares? If so, it's worth undertaking. Well, if you use that quote and think about it, Merton Miller has just given you a really clean look at one model that you can use for making board decisions. I'm going to break it down for you. This is what I would use. It's the Gordon-Shapiro growth model, where in the numerator you take free cash flow, which will be net operating profit after tax plus depreciation, amortization, minus capital expenditures, and I would also take out any payments that you make to executives for options. What's left over is the pure cash or cash flow that's available to the shareholders. And remember, as a board member, that's who you represent. So that's your pure cash flow that can then be paid out to the shareholders. In the denominator, you have cost of equity, and I use 10% here because Merton Miller said if you don't have anything better, just use 10%, but there are better ways to do it. But the cost of equity is reflective of the amount of riskiness of the firm. So if a treasury bill is trading at 1% and a cost of equity is 10%, it's 10 times as risky as the treasury bill for the same time frame. Then the perpetual growth rate is a rate by which you think you can grow the numerator or the free cash flow. Let's talk about how those work. Well, first I'm going to go back one time. This was a company that had it's a Mexican company that I knew. It had a $200 million free cash flow. It had approximately a 10% cost of equity, and this would have been 1992, and a 5% perpetual growth rate. Therefore, the market cap of this company was $4 billion. Then there was a crash in the Mexican market. People lost a lot of faith in the ability of the government to pay back money, and so the cost of the bonds went up to, the interest rate level went up to around 40% per annum, and then the cost of equity was 10%. The equity piece, so the cost of equity went up to 50%. They still had the same growth rate, and at that time they still had the same free cash flow, which meant their market cap had dropped, and this is an actual case. Market cap had dropped from $4 billion to $444 million, and this took about 3 months to happen. And it's just because that piece of the risk management, which was having a government which was out of control with its currency, cost the shareholders a tremendous amount of money. So the question is, what can you do now that you've done all the right things in your career, you're 30 years into it, what can you do to help assure the creation of that shareholder value? And one of the things that I would say is, number one, look at making sure that the management team is meeting or exceeding the budget that you've set for them, creating that free cash flow measure we talked about, and being able to pay an expected dividend. So that's where it starts. Then the other thing you have to do is help them understand what the risks are that they have to deal with in order to keep down their cost of equity. Now, if the whole currency goes to hell in a handbasket, you may not be able to do that, but there are other things that you can control. There are some strategic risks you can control, operational risks, financial risks, legal risks, regulatory, compliance, reputational. There's a whole list of risks that you can control using a disciplined enterprise-wide risk management approach. And by doing so, you'll be able to keep down the cost of equity. And then one of the most important pieces, and this is why almost everybody who's spoken has talked about innovation. This is why. This last piece is where some of the greatest shareholder value has been created in this business in the last 20 years. And that is innovation in product and innovation in process, and then execution, making sure that you do execute so people truly believe that you can execute. I think one good example of this is CME, by going electronic. In 2000, CME had 50,000 contracts a day trading electronically. Now I think it's close to 10 million trading electronically, and they make more money on electronic contracts than they do on open outcry contracts. That process shift alone to a workable electronic system created a huge wealth for the shareholders of the CME. In fact, in a 6-year period, it went from $750 million to $40 billion in market cap, just to give you an idea. So having a common language and metrics, I think, can be very helpful for a board and a management team for communicating, and it can be helpful to the shareholders so that they understand how you're thinking and acting on their behalf. Ira Milstein talked about how important it was to meld governance and corporate finance, and how good it is to have strong governance, not necessarily for what happens on a day-to-day basis, but when things get difficult, you want to have the strongest possible governance, because that's how you get the confidence of the market so that you can turn the company around and keep moving forward when others may not be able to. Anyway, thank you very much for taking the time.